Hi, I'm your accountant, and today I'm breaking down two common ways to record business transactions: cash basis and accrual basis accounting. Let's start with the cash basis. Cash basis is simple. You record income when you actually receive the money, and you record expenses when you actually pay them. So if you send an invoice in March, but the customer pays in April, you don't count that revenue until April. The upside is it's easy to track and closely matches your bank balance. The downside is it can hide what you truly earned or owed during a period. Now, accrual basis accounting. With accrual, you record revenue when it's earned and expenses when they're incurred, even if cash hasn't changed hands yet. Using the same example, if you perform the work in March, you record the revenue in March, because that's when you earned it. And if you receive a bill in March but pay it in April, you still record the expense in March. This gives a more accurate picture of profitability and financial health, especially for growing businesses with inventory, invoices, or long-term projects. Here's a quick way to remember. Cash basis follows the money, accrual basis follows the work. Which one should you use? Many small businesses start with cash basis for simplicity, but accrual is often required for larger companies and is generally preferred for financial reporting. If you're unsure, talk with your accountant. Choosing the right method affects taxes, planning, and how you understand your numbers.